When financial markets get rocky, people want alternatives. Now, this can help to ease volatility, diversify risk, with the goal of smoother returns. Today's audience requested quadruple header is between 4 anti-beta managed futures alternative strategy ETFs. So what's the best choice? Find out right after this. I'm Ron DeLegge. You're watching ETF Battles, an original program series that's now in season 6. And we're glad to have you here. Our goal is to help you make better investment choices. So if you need help analyzing any specific ETFs and you're not sure how they stack up versus the competition, send me your ETF ticker symbols in the comment section below or on our X feed at ETF Guide. I want you to visit the description section below. We got links to our program judges. We've also got links to our program sponsor Direction, who's been expanding their ETF lineup from single stock ETFs to more diversified index-linked funds. Lots of good choices there. So be sure, again, to check out the description section. We've got outbound links going to Direction, and also lots of good viewer resources down there, so don't miss it. Now, today's quadruple header, actually triple header, was requested by a longtime viewer named Gladstone. And it's between ETF ticker symbols. Strike that. This is a quadruple header. Man, am I scrambled eggs today. Scrambled eggs and sloppy joes. We've got BTAL versus MRSK versus CTA versus KMLM. Thank you so much, Gladstone, for this ETF battle suggestion. Judging today's contest, we've got Shana Sissel with Banrion Capital Management, also known as the Queen of Alts. And we've got David Dierking with TheStreet.com. Judges, welcome back. Great to see you.
Thank you so much for having me again.
Yeah, thanks. Good to see you.
So we've got our 4 battle categories of cost, exposure, strategy, performance, and then the mystery. Mystery, of course, is where our judges can surprise us with any factor or thing that they feel is crucial to today's contest. Our judges can also nominate wildcard ETFs if they feel there's better choices elsewhere, or they can opt for split decisions. It's up to them. I've got the scorekeeping duties, and at the end of the program, we will declare an overall winner. Keep in mind, none of the battle outcomes are ever predetermined or known in advance by myself or our judges. So it's sisters before misters. Let's begin with the first category, cost. Shana, please get us started.
Well, I want to start by saying that you're basically asking me to choose my favorite child in this battle. Because 3 of these ETFs are issued by partners of Banrion, BTAL, MRSK, and CTA. So you're asking me to choose between my favorite child. And I don't want to make any of my clients mad. So with that in mind, I will do my best to provide the viewers with very objective, clear, and David can keep me honest. In terms of expenses, there's a couple of things that are worth noting, and that is that in this alternative space, especially with products that short within the fund, there are some regulatory requirements in the calculation of their expense ratio that results in what I call phantom expenses. So the only one of these ETFs that it impacts is BTAL, because it's the only one that is actually shorting within the ETF. Individual securities. CTA and CMLM are going long short, but they are investing in a Cayman Islands based product. And so they're like investing in a fund that shorts, and in the Cayman, it's calculated and taxed differently. But BTAL actually does short individual securities. So they are impacted by this phantom expenses, meaning that the SEC requires that they add back into the expense ratio the cost of shorting, meaning the cost of margin, as well as the cost of any dividend payment that they have to pay. But it's phantom because it's also calculated as part of the NAV of the value of the security. So it's not really an expense it's being double counted. So in this battle, BTAL is my winner. And the reason why is because even though the stated expense ratio everywhere you look is 1.43%, that isn't the actual expense ratio. The actual adjusted expense ratio is 45 basis points. That is the actual expense ratio that anybody who invests in this fund is paying. It's not 1.43. That's with the phantom, and then the adjusted is 45 basis points. As such, it is the lowest expense ratio of the four. It has a spread of 3 cents, which is the lowest of the four. And so for that reason, BTAL is my winner. And again, I felt the need to preface and allow the viewers to understand that there is this phantom thing that happens. And anytime you're evaluating an ETF that is shorting actual securities, not using futures, not using options, not using some sleeve impact like the CTAs, actually short, where you look at the holdings and it shows the short position, it is going to be impacted by this SEC rule. And so you need to go and look in the prospectus to find out what the adjusted actual expense ratio is. And in the case of BTAL, it's 45 basis points.
The devil is in the details. Thank you so much, Shana, for that strong start. And we appreciate that. Dave, you're up next. Give us your analysis on cost.
Well, and this is why I am not the queen of alts or anywhere in the royal court or even in the building. That was, I don't think there's anything I can add to that. I was looking strictly at expense ratios, but maybe I should change my mind now based on what Shana said. I was looking at CTA with the expense ratio of 76 basis points as the pure lowest stated expense ratio, obviously. Not the case with BTAL, as Shana laid out. Spreads on these funds are okay. There's enough liquidity to trade here. I'm just going to stick with my original choice on this one, CTA based on the lowest expense ratio.
Okay. Well, thank you very much. That takes us next to exposure strategy. And Dave, you're up, so break it down for us.
Yeah, Shana kind of started laying this out already. These are really some different strategies within this sort of risk management umbrella. BTAL, again, is long, low beta, short, high beta. So it's designed to really outperform regardless of what the market's doing, as long as low beta is outperforming. So it can generate gains in both up and down markets, which is what you want in a good hedge. And BTAL's got a relatively large negative correlation with the S&P 500, so that could be a good match. MRSK is pretty much kind of a standard S&P 500 holding with a protective put on it, and then an out-of-the-money covered call in order to help pay the fees for that put. So in an up market, this is going to pretty much look like the S&P 500, and it's really not going to provide much protection unless things start heading down. And then, of course, you've got the cost of the option strategy, which is going to be a performance drag on the fund overall over the long term. CTA and KMLM are kind of your traditional managed future strategies in that they're looking at, currencies and energy and commodities and all these other things to sort of diversify the portfolio and really give you sort of that risk managed component to your portfolio. So in that sense, I like those two funds a little better. I do like CTA in that it specifically excludes equities from the equation. So it tries to give sort of a pure non-correlated portfolio that'll do hopefully a little better over the long term and managing the risk of the portfolio. So I'm going to give the slight edge to CTA here because I think, this fund and KMLM probably do a better job of more traditionally what managed futures are supposed to do.
Thank you, Dave. Shana, you're up next for exposure strategy. How do you see it?
So this is where the asking me to pick my favorite child part comes in. I actually use all of the products BTAL, MRSK, and CTA in my model portfolios because they actually are complementary to each other. And when you're building an alts portfolio, you really want to have, just like with equity and fixed income, a diversified mix of strategies. I usually pick 4 or 5 that have low excess return correlations to each other and then low correlations to traditional fixed income and equity. I use MRSK as kind of juice in the portfolio when markets are going up and having that really negative correlation from the CTA, and BTAL is not helping. But they are, as Dave pointed out, very different. So BTAL is a market neutral fund, which means it goes long and short in equal measures. It goes, as was pointed out, long, low beta and short, high beta. It looks at the 1,000 U.S. stocks and the Dow Jones index, and it picks what it goes long based on the top quartile of names, and then by sector, and then it's neutral and its weightings by sector, it's equal weighted. And then on the short side, it does the same thing to pick its shorts. And the goal here is to have literally neutral exposure. So it should be neutral sector, it should be neutral in its individual stock weightings, and it's supposed to be beta 0. And so that's the focus. What I like about this product is a lot of market neutral funds, the gain you get, it has, as was pointed out, nothing to do with what the market's doing. So it has to do with, are your shorts underperforming your longs? Because that's how you make money. Even if they're both down, as long as your long book is outperforming your short book, you have positive return. So it's a lot about stock selection, and this product is very clear in what it's trying to achieve. It's trying to achieve the arbitrage between the outperformance of low volatility stocks with high volatility stocks. And when low vol is outperforming, even if the market's going up, BTAL will do well. And vice versa, if higher beta names are doing well and lower beta names are not, it will do worse, and it will be magnified in both directions because of the nature of these products, right? Because it's basically low vol on steroids, because you're not just getting low vol exposure, but you're actively choosing to short high vol. And so that can lead to quite a bit of volatility. This fund is, I've seen it profiled by a lot of quote industry expert websites who have no knowledge and no understanding of alts in general, and they don't understand how this product works, and they just trash it and say, well, you can buy managed futures. And I would say, well, that is a cop-out, because this is not a managed futures fund, and those two things play different roles in the portfolio, and they're not actually correlated to each other, and they actually can both be used at the same time and add value. So BTAL's role is an important one, and quite frankly, if you look at what it did in this last month, particularly with the DeepSeek stuff, it crushed everybody else by far, even the managed future strategies, when the market was going down, because of the nature of how its performance. Now, MRSK is looking to give you market exposure. It wants to give you the return of the S&P 500. It just wants to protect you on the downside. Generally speaking, the product does just that. So when the market's going straight up, it consistently will perform in line with the market, maybe with a little bit of underperformance just due to the hedged nature of the products. It does use puts, long dated puts contracts to hedge on the downside, and then pays for them by writing call options and put options and then playing on the spread. So it's near or in the money long-term put options, and then it writes far out of the money call or put options and plays on the spread to pay for the cost of the puts. That's unique. Most of these buy right strategies that are doing this type of product don't actually do that second effort to try to cover the expense of it. So that helps the fund keep up with the markets. So it will do well in good markets. And that's why it's in portfolios that I use. It has downside protection, but gives you market performance if you think the market's going to go straight up. Now, the CTA funds are managed future funds. They are very much, managed futures are completely uncorrelated with traditional markets. They're basically trend following. They use futures to take advantage of global trends. Another version of this that just expands what the underlying base of investment opportunities are is called global macro. And CTAs is a strategy that goes back forever. In fact, the KMLM product is based on the Mount Lucas Index, which has been around for decades. CTA is actively managed and KMLM is not. So they're doing the same type of thing. They're structured the same way, but CTA being actively managed has done better performance-wise. So now you're going to ask me which one I think has the best exposure strategy, and I can't pick. They all have merit. I think the one that implements the most unique strategy that stands out in terms of like doing something that you don't see its peers doing is MRSK. So market neutral is not a new thing. Hedged equity is not a new thing. Managed futures is not a new thing. The only thing that MRSK is doing that is unique is this writing calls and puts to cover the cost of their long dated put options for the hedge. And that is unique. So if I have to choose one, again, you're asking me to choose my favorite child, I'm going to choose MRSK just because if you look at it in the advantage of hedged equity, which is the category it sits in, that one thing is unique to them, and it is not something that you'll find in a lot of other places. So I will give it to MRSK, but I just want to go on record saying that I think all of these strategies have merit in what they're doing, and they're very different. But in terms of what is unique, that's the only one that has something truly unique that it's doing that you won't find somewhere else.
Wow. Solid analysis. And I can tell you none of your children are angry with you right now.
I don't know. I'm going to have to check with them. They might be after this airs.
All right. Well, that takes us next to performance. So Shana, you're still up. How does the performance of these 4 ETFs look?
So this is going to be super point in time biased.
Yeah.
And that is, if you were to look at these funds in 3 months or in a year, there would be a completely different winner. So I'm just going to start there. Point in time bias right now, the winner is BTAL. BTAL's performance on 1 month, year to date, 3 months is superior. CTA has a much better 1 year number, but doesn't have a 3 year number. And BTAL has, a stronger 3 year number. It's kind of in line with MRSK. So I'm going to give it to BTAL. But again, I prefaced that by saying if the DeepSeek thing didn't happen earlier this month, this would not be the case. It crushed during that downturn because technology stocks, specifically NVIDIA and all the AI names or high beta names that are short in the portfolio. So it did great. But it is very point in time. So I'm going to choose it as my winner, but I'm going to preface it as saying that from a consistency standpoint, for a fund that's going to give you good outsized returns that is not correlated with some consistency and you're not going to have this volatility, the winner is CTA.
So it's a tie. All right. Gotcha. It's between CTA and BTAL. Thank you, Shana. Dave, you're up next on performance. How do you see it?
Yeah, Shana made the same point that I was going to, in that these aren't funds that I don't think you can really judge on performance in absolute terms because they try to do so many different things here. Looking back, since CTA is the most, is the youngest of these funds. It's about 3 years old. And if you just look at absolute performance since then, CTA is the winner. It's up about 38%, I think, is the number. But again, like Shana said, these are very situationally dependent, and they're all going to outperform in different situations. It just really depends on kind of what's happening at the moment. And again, that's the good thing about these funds. If you can find very different hedges to however you want to layer that on your portfolio. So I'm just going to stick with the since inception return, or since the common inception return, and call CTA the winner on this one. But again, same disclosure that Shana made.
All right. Well, that takes us next to the mystery battle category, where our judges can pick a certain factor or thing that they feel is important to today's contest. So, Dave, what is your mystery battle category, and which of these ETFs wins it?
Yeah, my category is going to be the efficient frontier. And I look at that because, if these funds are really designed to, risk manage and diversify, you really kind of want to find out what the right balance is that sort of maximizes risk-adjusted returns. And MRSK, there's really, not much different than the S&P 500. The market really hasn't gone down substantially over the last 3 years at any given point. So there hasn't been a significant amount of advantage of pairing that up with the S&P 500. The other 3 funds do a much better job in the right quantities. And usually that's somewhere in like the 50 to 60% range, S&P 500, and about 40% in one of these managed futures funds or in a fund like BTAL. If you look historically, I found that CTA has done, at least recently, the best job of producing better risk-adjusted returns over the last year, and that's been roughly a 40-50% allocation to CTA, with the rest going to the S&P 500. And that's done the best job of managing risk-adjusted returns. Now, you're giving away a little in absolute performance, to get that. But the trade-off is on a risk-adjusted basis, you're doing a little better. At least you've done better over the last year or so. So I'm going to call CTA the winner on this one. But again, for the same reasons as performance, it's really kind of situationally dependent what you're looking to do and kind of what time period you're looking at.
Thank you, Dave. Shana, you're up next. Your mystery battle category, what is it, and which of these 4 ETFs wins it?
So I appreciate David's aggressive nature of saying 40 to 50% in one of these names. I would never, ever put that much money in any of these. That's not what they're meant to do. In fact, they will, yes, will help with risk, but they will absolutely start to eat at your returns. I would never put more than 20% in an alts fund in a diversified portfolio, like ever. That's like the optimal percentage to do an alt sleeve, a diversified alt sleeve. I wanted.
Yeah, I think he did that just as an example.
Okay.
Yeah.
But I'm actually kind of going to use the same idea in approaching this. What I wanted to look at is which one of these funds provides the most ability to even out the ride without taking too much away from your returns. And as much as I love CTA, it doesn't have a long enough track record for me to really have high conviction in the analysis. If you just were to replace CTA with KMLM as a proxy for managed futures, it doesn't actually help as much. In that sense, I want something, and this is going to sound crazy, that has high vol, but not volatility correlated with traditional markets, right? So this is the Bitcoin argument sometimes. If a small percentage of Bitcoin, even with its insane amount of volatility, can juice your portfolio in a meaningful way. And in that case, the winner is BTAL. So BTAL, even with its crazy vol and the fact that it can be up 19% and then down, 15, the nature of the volatility of returns and when that up and down happens is so negatively correlated to the markets that it evens out your ride. But if you don't put a huge percentage of that product in your portfolio, it's not going to eat away at your returns. So for me, if I were just going to pick one, it would be BTAL, and the weighting would be somewhere between 8 and 10%. Against a 60-40. And it would give you the most amount of alpha without taking away from returns, and it would absolutely smooth out the ride. However, I tend to use these funds as a basket, and I don't use KMLM because I pick one managed futures fund, and for me that's CTA because it's a better fund, and we've kind of established that. And I choose those 3 funds: BTAL, MRSK, CTA, and then I throw in 2 more funds with them, CBLS, which is the CLOW equity fund, which is a long short actively managed, almost hedge fund like strategy. And then I put in a fund called RDFI, which is by Rareview Capital. It's a Rareview Dynamic Income, which is a closed end fund arbitrage kind of thing. And I take those 5 products and put 5% in each, or is it 4% in each. And then I have that as a 20% sleeve within my traditional 60-40 arrangement. So it ends up being like 50, 30, 20 or something like that. But that's how I do it. And that gives you the maximum risk return.
Just a quick question. Within that 60-40 sleeve, is that percentage reducing the 40 or reducing the 60?
Both. So that's why I said it ends up being more like a 50, 30, 20.
Oh, gotcha. Okay. Perfect.
Yeah.
Thank you for that.
I actually do it a little bit differently, but that's the simplified version. Personally, if somebody gave me $1 million, I would take 800,000 and put it in a 60-40, and then take 200,000 and put it in this alt. But that ends up with like a very, like I would have to pull out a calculator, and it's not clean. But it essentially is like 50, 30, 20.
Got it. Okay. Well, thank you very much, Shana, for that detailed analysis. Now we're going to give our judges an overall final opportunity to give us their overall winner. And so far, my scorecard, this has been a quadruple header, but it looks like there's 3 that are leading the way and vying for the win. So how will this go down? Shana, give us your final take.
So I think we've sort of established there's nothing against KMLM. It's a very good managed futures strategy. It's based on the Mount Lucas Managed Futures Index, which has a very long track record. I wrote a white paper on the benefits of alternatives for diversification in 2009, 2010, and I used that as my managed future proxy. So it has a super long track record, but it's passive, and you can actually add a lot of alpha in an actively managed CTA portfolio. So CTA beats KMLM, so it's just, scratch off. So now I have these 3 left. I'm going to tell you that I have 5 winners because that's how I would build a portfolio. And it would be what I just said. It would be BTAL, MRSK, CTA, CBLS, and RDFI. And those 5 funds are my winners of this battle because I would use them in combination and I would never use any one of these on their own at all. And so I have a 5-way tie of those 5 funds because that is the allocation portfolio that I manage, that I actively manage at this moment. And that's how it's allocated.
Dave, your final chance to weigh in with your overall winner.
Well, I have no favorite children here, so I'm just going to speak my mind. I like CTA on this list. You can look at costs, you can look at short-term performance, things like that. I don't think those are the driving factors of why you'd want to choose a fund like this. So I kind of lean on the exposure strategy as my tiebreaker. I just like how it's constructed. I like the long-short nature of the multiple assets that they use in constructing the portfolio. I like that equities is kind of removed from the equation, so you have a true uncorrelated asset. I think it's just got the best structure and composition for, I think, what you're looking for out of a managed futures product, and it just checks the boxes for me. So I'm going to go with CTA.
Well, our judges have weighed in, and according to my final battle scorecard, this is going to be a split decision between 5 ETFs. We had 2 wild cards from Shana, CBLS and RDFI, and then it was between those 3 in today's headliner, BTAL, CTA, MRSK, and we had a lot of different children in this battle, so to speak. Shana, of course, making the argument that each of them does something a little bit different. And so in that sense, they complement each other rather than compete. Dave bringing his point that CTA, he likes, obviously, it for all of his, actually, it was pretty much a clean sweep for him on all categories. It is actively managed, so it does kind of the same thing as KMLM, but with an active hand. And wow. We got some incredible analysis today on today's program. We had the Queen of Alts breaking it down, and of course, Dave's solid analysis. What did you think about today's showdown? Let us know in the comments section below. Shana and Dave, great job. We couldn't have done it without you.
Thank you so much for having me. I love these alt battles. Keep them coming.
Yeah, when the chef's cooking, get out of the kitchen. It was fun.
Poor Dave has to be on the show with me, and he is like, why? Why are you doing this to me, Ron?
Hey, I learn as much as anybody on this. This is beneficial for me as well, so I love it.
Iron sharpens iron, as it says in the Proverbs, and so we definitely appreciate that solid analysis all the way around. Be sure to hit us up in the comment section below with your ETF battle suggestions. Again, a big thanks to Gladstone for this particular battle suggestion. Nice job. I'm Ron DeLegge. Thanks for watching ETF Battles. We'll see you on the next episode.